Well, first of all, my name is Peter Hafez. I'm the Chief Data Scientist at RavenPack. I'd like, first of all, also to thank Optirisk for having us here to speak at this exciting conference on AI, machine learning, and sentiment analysis. As part of my presentation, I wanted to, as a company, RavenPack has been part of the quantitative community for almost 15 years, and we have seen firsthand how the quantitative investment community has changed over time and how it has started to consume more and more data. And I wanted to give my view on what the winning formula is or how to succeed in quant investing in today's world of big data. So it's a little bit of a flashback, this picture. We have seen something similar earlier today. But data is growing at an incredible speed, right? 90% numbers, there are numbers out there saying that 90% of all digital data that exists today has been generated over the last 2 years. Nearly 80% of that comes as unstructured content, which is generally considered hard to consume. So we are talking about imagery as well as text and other things as well. With all of this data that has become available, of course, it also offers both challenges but also a lot of opportunities for investment firms to identify new sources of alpha that moves beyond the more fundamental and market data. But consuming all of this content also comes with a bit of caution. It can be very dangerous consuming directly from the fire hose, right? We have thousands of different data sources out there that have become available, and it covers, quantitative hedge funds today are using anything from satellite imagery to social media data. They look at, location of foot traffic information as well as credit card transaction data. And of course, in the middle of all of these different data sets, you have RavenPack sitting there in the middle with no obvious competitors, delivering information on event detection and sentiment analysis. But one of the things that we have seen is that a lot of these more sophisticated quantitative hedge funds went out early and hired big teams of what you would call data hunters that would scour the world for interesting data sets that no one else were using. And of course, there were, as the fintech industry has evolved, more and more data sets turned up. And I've heard numbers that said that there are like lists out there with 9,000 different kind of companies that could cater for the financial industry from a data perspective. However, what we have seen over the years since we started is that the market has become more mature. And today you have, you can find a lot of sell-side research reports that kind of gives you a good overview of what data sets are out there. Very recently, JP Morgan came out with a tour de force of a report that contained something like 600 different vendors, data vendors, that you might want to look into if you want to dig into the alternative data space for creating alphas. So that also means with all of these various reports being available, that it is becoming less of a differentiator for financial firms, for quant firms, to have data hunters out there, right? Because if you're new to the game, you have a place where you can find a good list of some of the more prominent data vendors, some that have more proof behind it, and of course also a lot of new exciting data sets. So where is the edge today? Well, the edge is in efficient processing, not in being the only one having the data. Because it is an old school thinking to think just because you have proprietary data that you will also have proprietary information. And information is that will be driving alpha, right? Of course, there are companies out there that truly sit with a competitive advantage in having proprietary data. So you obviously have your companies like Google and Facebook, Apple and Amazon that sits with massive amounts of data that will have great insights into consumer behavior, right? And these guys, if they decide to create a hedge fund, they will be very hard to compete with. But one of the reasons for why just having a data set, one proprietary data set, why that is not giving you that edge Well, it's because, as you saw in the previous slide, that you have multiple companies within each of those buckets. You have multiple companies that look at satellite data. You have multiple companies that can provide, foot traffic information and so on. So you are not the only one. If you have one data set out there, or one of the data sets in a proprietary, or you're receiving that in a proprietary way, there may be 99 other data sets that can give you that same or similar insight. So you'll see a lot of these alternative data sets being correlated. And one of the things that you also have to remember that a lot of the alternative data is used for nowcasting of fundamental data. So giving us a real-time update of what future earnings or revenues might be. But you can go at that number from many different dimensions. You could say, both credit card transaction data as well as traffic or foot traffic data will give you some proxy of what earnings will be, right? So you're not only having alternative data sets available, other data sets available within your own bracket, but other brackets within how you would classify your data sets can also tell you similar things. One of the things that we have also identified, or what we can see, is that the alpha landscape has changed. More and more quant funds have turned up. They have attracted more and more capital. And that has influenced the alpha landscape, right? So we are seeing, if you compare to the 50s and 60s or 70s, where very few factors were really driving asset prices. Today, you have a lot more. You have potentially thousands and thousands of alpha sources that you could potentially consume. And one of the things that have also changed is that decay is faster. So each individual signal has shorter duration. So what does that mean? It means that you need, as an investment firm, you need to consume much more data to be able to continue to grow your AUM. Or at least to maintain your current AUM and this current performance. And there is a true pressure on cost as well, because each individual alpha contains, less marginal value. You need to go from text or unstructured to structured as cheaply as possible and turn it into an alpha as cheaply as possible. Otherwise, you won't be able to, grab the alpha that there might be in a data set just because it's too costly to get it out. And of course, that also puts pressure on infrastructure, on storage, because now you have to consume all of this data. You need strong, powerful computing, because you have to, again, handle more data, but you also need researchers, the human element, right? We're still not at a stage where we can just take a bunch of data, put it into an AI, and alphas come out of it. We need humans. So we need to hire lots of data scientists that can turn all the thousands of data sets into potentially thousands of alpha streams, right? So big data, trading on big data is really a numbers game, right? And we have hedge funds out there that are trading off of not thousands, but even reaching the millions now of alphas, weak learners, right? They're not necessarily strong standalone trading signals, but by combining them into a super alpha, they can make it tradable. But the problem here is that there is a battle going on, right? There's a war on talent, and it's real, right? And it's not, because it's not just in finance that we crave data scientists. It's the whole fintech industry and beyond fintech as well. They need data scientists. So we have started seeing new interesting models turn up on how we can hire talent, right? We need to move beyond the local pool of talent and go after a global pool. And you can see a company like quant. I don't know if you're familiar with them, but they're one of the top quantitative hedge funds in the world. And they used to be linked with, or are still linked with Millennium Capital. They have taken kind of the consequence of that and have set up various, or quite a lot, I think they're reaching, I don't know the exact number, but something like 45 different local offices around the world. They want to be where the talent is. Other firms like Two Sigma and Winton Capital have gone after the global talent pool by running various competitions on Kaggle, right? The Google-owned data science community with more than 500,000 data scientists. So they have run various data exercises to see if they could identify talented individuals that they could then hire. But you have also seen the other sides, which is called the crowdsourced alpha space. People that have made infrastructure available or platforms available where you can go and create, consume data. They have data included as part of the platform. You can go and consume that data. You can build strategies, and you can use their backtesting engine, and they will track your performance, right? And companies operating in that space are the more prominent ones, Quantopian, Quantiax, and more recently also Numeray. I will say that there is a little bit of a battle between the two, and whether who will be what is the winning formula here, right? It's the battle between the more established firms and the newcomers that are to a large extent using technology and so on to solve that recruitment challenge, right? And I think it's an interesting battle. And I wanted to list some of the challenges that I potentially see with this, both from a sustainability point of view as a hedge fund, but also from a vendor's point of view. Quantopian, you may have heard of, one of the more prominent ones. They recently raised $250 million from 0.72 that they can allocate towards their data scientists. They have about 130,000 data scientists on their platform. I just heard last week that out of 130,000 data scientists that they have identified 50 people that they are ready to allocate money to. So the question is if it's really about crowdsourced alpha, or if it's really it's more similar to what you're really seeing on the other side, where it's really about talent recruitment. The other thing that you also have is, what type of data can you access? As a data vendor, we feel very uncomfortable having to open up all our data to the all data scientists out there, right? We want to, of course, protect our premium price points that we're selling into institutionals. So I see a real challenge for these crowdsourced platforms to get any premium data set out there. And the data set they have are often from newcomers that don't really sell much data into the institutional space and therefore don't have that much to protect, and they try to say, let's carve out a market in this area. But in the end, the quality of the data that they have, you can question that, right? So, and of course, if you don't have good data, it will be tough to build strong alphas. Someone like quant has tried to address that more. They also have a crowdsourced platform, but there they crowdsource algorithms. So they may give you some data just to play around with, just to figure out who you are, and then they might end up hiring you as a consultant. So they still take the same approach, but really, again, for talent recruitment, and they can handle the premium data problem that way. We have also seen, Numeray has an interesting approach to it as well, trying to solve it by encrypting content, right? So you don't see what data it is that you have. So you kind of let the data speak for itself. And that's interesting because you can start to mix in all kinds of premium data. You don't really, people can't really, see whoever the vendor is and so on, and therefore more vendors might be willing to do that. But of course that gives you another problem, and that is there's no way of applying domain expertise on the data or domain expertise from a financial perspective. It's really just about the data and how good you are in making inference from data and into some target asset, right? And there's a lot of debate going on in the financial industry now can you really create alphas that work out of sample without any domain expertise, right? You may very easily be overfitting and all of these things. So it's of course there are techniques, machine learning techniques to kind of solve or try to solve these type of overfitting risks, but most of the time people in finance likes it to have some financial fundamental reasons for why alphas are there. And the other thing, of course, that I'm very interested in seeing going forward is if there will be a brain drain. So if you go to the Quantopians and you kind of get a track record as a data scientist, what will prevent you from saying, I know that I can trade, I'm one of the good guys. why don't I jump over to one of the established firms that already have AUM available and that have it much easier, I can get a much bigger allocation with these guys because 250 million for one company, it's a blip in the ocean, right? These guys have billions. So interesting space to follow. The other thing I wanted to address, and something we haven't covered, so we looked at, consume a lot of data, use that data and turn it into alphas, but how do we do it? We talked about 80% of it coming unstructured. So in order to turn it from unstructured to something usable, you need to figure out whether you want to build or buy, right? I'm obviously a little biased here. You can probably guess on what side I am, but I want to just address or mention at the very high level 4 things you need to consider as an organization if you want to go one route or the other. First of all is, of course, you need to think of IT infrastructure. You need to put large investments into handling very, very large data sets of raw content. It's massive if you really want to get started, right? And of course, the cloud has made things easy in terms of scalable storage and scalable computing power, but it's still a quite significant investment to set you up as an organization to start to take advantage of such infrastructure. And you shouldn't underestimate how much also comes in terms of data cleaning and service maintenance, right? So making sure that the quality of the content is high is non-trivial. You will see bad encoding, you'll see bad timestamps, gaps in history, and bad metadata to work with and so on. And you also need to find that guy who needs to get up in the middle of the night if your service suddenly stops working, right? So there's a lot of stuff going on there to, can you say, create a product in-house within a company and making sure that the service, it's easy, is functional. It's much easier just making a phone call and blame the vendor, right? The other thing which is also often underestimated, especially in finance, is that in order to do well, if you have text, you need to be able to relate that to tradable securities. And the best way of doing it is going through doing entity detection, right? So you need to be able to say, what companies are in there, what organizations may be mentioned, what places are we talking about. And by doing that, we can relate it to tradable instruments. But entities change over time. And there are no good databases you can just go out and buy. And as quants, we want to have point-in-time sensitive information available. So not only do I need to keep track of entities today, I need to keep track of entities in a time-sensitive way throughout history or the start of the data set the first data set that I have, right? And companies, for instance, are acquired. They go out of business. Government organizations change. People die. So it's a non-trivial task also to maintain proper entity databases, and something that people tend to forget. And of course, the last thing, you need to build expertise in natural language processing. And it takes time, and it's expensive. We have been in the game for 15 years. We do nothing else than that, and we are more than 50 people. So it's many, 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 many man-years of work that has gone into it. It's both an art, or it's both science, but it's also an art. And you have already entered one talent war, and that is, how do I actually turn data into alphas? Now you also have to figure out, go into another talent war for natural language experts that turn data into useful data. So just to summarize some of the things that I've talked about, what is the winning formula? Well, consume a lot of data, as much data as possible. Turn that data from unstructured to structured. That makes it more easily consumable within your existing process. You need to hire a lot of data scientists or quantitative researchers to turn that structured data into alphas. And then, of course, you're already close to being off to the beach and enjoying life. So where does RavenPack fit into all of this? Well, we make unstructured content actionable for financial professionals. And the way that we do it is that we're adding structure to it. We codify it by tagging content with entities. We do also topic or event detection and temporal scoring. In terms of event detection, we have a taxonomy that covers almost 7,000 different types of events. anything from rumors for mergers to bids being made in an acquisition, the acquisition bid going through board approval, you going through regulatory scrutiny until finally the acquisition or merger fails or is successful. We cover anything from earnings, unemployment, interest rate guidance, political, societal risk. We track litigation issues, we track elections and so on, and also environmental issues. So you're able to relate those different dimensions to the tradable securities that you're interested in. We will tell you how relevant entities are within documents, whether it's detected in the headline, deep in the story body, whether it's detected amongst many other entities. We'll also tell you how relevant the events are, whether it's detected in the headline of a story or deep into the story body. And one of the things that we do find, which we have found interesting, is that if you look at US large cap, it's mostly headline driven when it comes to prices, but it's much harder for a small cap stock to reach the headline. And therefore, you want to dig much deeper into story body when you do event detection and you want to build trading algorithms. We also find that if you trade commodities, in the long run, it's mostly economic sentiment driving it. But in the short term, it's political and societal and environmental news driving oil prices. If you wish to trade Forex or interest rates, it's mostly economic news. If you wish to trade equities, it's company-specific news, but also macro news at business or economic level. So we don't believe necessarily in one sentiment score for the US economy. We believe in multiple sentiment dimensions. And the dimensions that are important depends on what it is that you wish to trade. So event detection is key, right? We also do novelty scoring. So is the information that we are putting in front of you new or novel? Or is there a lot of buzz around it? Have you seen it before? Both metrics are interesting depending on your use case. Whether you are trading intraday and you just want the new and most novel, or you are trading over a longer horizon, say there's a certain trend behind a particular topic. And of course, we also, and something which we are very known for, is sentiment analysis, right? And I tend to say that sentiment will give you a sense of strength and direction, but what it won't give you is a sense of how quickly information gets incorporated into price. And so therefore, combining event detection with sentiment scoring is key in successful sentiment trading. I'll open up for questions now. And of course, if I don't get to cover all your questions, I'm more than happy to speak with you in the break as well. We have a booth out there. We'll be happy also to show you our product in greater detail.